All right, so mortgage rates are getting a little breathing room this morning, but whether that relief lasts will come down to one thing this week: the labor market. We finished last week with mortgage rates moving higher as treasury yields remained elevated and investors continue to worry about inflation and the energy prices. But coming in today, oil prices are pulling back and the treasury yields are improving as markets react to renewed diplomatic efforts between the US and Iran. So that is giving mortgage bonds and rates a better start to the week, but there's a lot of important employment data still ahead for this week. Tuesday, we get the JOLTS report, that's job openings. Wednesday brings us the ADP private payroll report. And then Thursday, we get weekly jobless claims. But Friday is the big one here. That is where we get the Fed's favorite measure of unemployment, that BLS jobs report. That is the biggest report that they look at when we're looking at unemployment in the US. It comes out early Friday morning, and that will decide which direction the markets are really going to head going into the end of the week this week. If hiring slows, wage growth eases, or unemployment moves higher, that could mean mortgage rates build on this morning's improvement. And as unemployment goes up, interest rates actually go down. But if employment and wages remain strong, well, that's a different story for mortgage interest rates. Now, for buyers under contract, don't assume today's pricing will automatically be available after the jobs report. The market is going to change. I'll be watching the market all week, so if something comes up, reach out. If you have any questions, reach out to us directly.